And we're live. What's up, team? On Twitter, Facebook, YouTube, the whole thing, the interwebs. We're getting down. I'm working on sound effects. We're getting there. We're getting there. May not be all the way there yet, but we're getting there. Yeah, see, I keep forgetting the loop. I don't know why it automatically does that. So big numbers today for inflation. Not ideal. Not ideal. But hopefully yesterday I prepared you well for what was going to take place today. You know, we said that we were expecting, and a lot of people were expecting the number to be worse than previous. So continued acceleration on the inflation front. But also we know that this is lagging data and that a lot of the stuff that is built into these calculations has come down quite a bit, has deflated, if you will, since that report end date. So it's called the statement ending date for this report, which means next month, these numbers should cool off quite a bit. And it'll be interesting to see what happens between now and then, how the market plays that. But very well could be the worst of it. Could be. Might not be. Anything can happen in markets, right? Anything can happen. But it sure looks like it. So if we take a look at this inflation, 9 points at the 9, ooh, it's a crooked number. A lot of people say, oh, no, it's going to keep getting worse, 10%. Then it's going to be 12. I really don't see that. We're definitely going to see a lower number next month. So we'll have to see what happens from there. But a lot of stuff has come down. So consumer price index, CPI, as it's referred to, increased 9.1% from a year ago, June, which was above the 8.8% Dow Jones estimate. And, you know, not by a lot, but still worse, right? It's like, are we ever going to get past this inflation thing? In order to get past inflation, we have to have deflation. By the way, I'm considering doing a series just debunking a bunch of like videos. People send me videos all the time. Hey, watch this, check this out. And I always watch them. I do every time. Because I'm curious if I'm missing something. I can consider research. And it's always so bunk. I mean, I haven't seen anything worth a darn, at least on the crash from the people who are saying, oh, the markets are going to crash. There's going to be this massive collapse. I watched one yesterday. Was really a joke. So I may start just like roasting these videos. So if you see something like that, send it to me. I very well may start roasting these as just a pastime. Since I have time on my hands, you know, there's only so many loans to go around these days. Excluding food and energy, core CPI rose 5.9%, compared to the 5.7 estimate. So core is, you know, a bigger concern. Again, higher, not crazy higher, but higher. Cost surge for gas, groceries, rent, dental care. We know all this. Adjusted for inflation, workers' hourly wages fell 1% during the month and are down 3.6% from a year ago, adjusted for inflation. Now, what happens if we start to see deflation? Which, by the way, there are a number of different deflationary measures taking place right now. If you look at the DXY, this is the dollar index. I talked about this. It's cascading higher. So the dollar is getting really strong. People who are traveling abroad are noticing this. Your dollar is going further. So what we really need to understand is what inflation and deflation actually are and what they mean. Because if we are now past, if we're over the hump, if the inflationary aspects have peaked, which I believe that they have, I could be wrong, but that's what I think is happening, then we're going to start to see deflation. What does that mean? That means that things will come down in price. Could be, you know, that homes come down in price, although usually they're the strongest hedge against inflation or deflation. Could be the homes come down in price, gas comes down in price, stuff at the store starts coming down in price. As demand diminishes, price will come down, right? And as more people hear, oh, we're in a recession or recession's around the corner, or, you know, this and that, the sentiment is getting pretty negative. We talked about the cycles, the emotional cycles, and how I believe we're at the fear stage. We haven't seen the panic yet. We may not, but we're at the fear stage where fear is abundant. It's everywhere. Or abounding, I should say, abundant and abounding. We're cascading higher here in the dollar index, which means the dollar is getting stronger. What's actually happening as a result of this is it's hurting other global economies. So other countries whose currency is getting weaker while the dollar is getting stronger is causing problems for them, especially, you know, for commerce here. This could cause a lot of money to come into the United States. It could cause a lot of people to want to get into dollars. Not that that would be the smart move on their part, but it could cause that to happen, which would mean that we could see an influx of foreign investments into the United States in multitude of different ways. If the dollar remains this strong in comparison to the rest of the world, that means the dollar goes further. So think about it this way. Deflation means the dollar is strong. A strong dollar buys more. A weak dollar buys less. Inflation has allowed prices to go up, right? Because inflation means that you get less for your money. So that's, prices are going up, you're getting less for your dollar. If the dollar is going to strengthen, if we're going to see deflation, by the way, the Fed raising rates is deflation, right? It's deflationary. Then cash becomes king again. And this is where things can get really interesting. If we get to a point where cash is king, and we've been talking about this for a while, I told you this day would come. When we get to the other side of this inflation mountain that we've been climbing, bonds will become very, very attractive for the exact same reasons, the inverse reasons why they're unattractive during inflation. During inflation, we have 9% inflation. You buy a bond for 4.5% interest. Okay, you get a yield of 4.5%. You're losing 4.5% to the 9% inflation. Plus, you have risk. So yeah, you're making some income, you're making some cash, but you're losing out to inflation. Well, the opposite becomes true in deflation. Let's say we're deflating now, even though overall we're still seeing inflation, it's decelerating. So there's some deflationary elements there. If we get to a point where you're seeing deflation of 2 or 3%, then the opposite is now true. Now you want to park your cash somewhere because your cash is growing in value just all by itself. And in deflationary movements, cash grows in value even if it's mattress money because you can buy more with it as the deflation goes on. And so if you can also make 4.5% or 3% or whatever on your bond, and your cash is growing on top of that, that starts to look pretty sexy for a lot of people, not just people, but institutions. And that's what I've been trying to explain. I've just had this epiphany of how to explain it a different way. And this is why bonds could become very sexy. I had already done a little bit of analysis here for someone who we just locked a rate for. By the way, rates are great. Rates are terrific. We're just locking another rate, conventional loan at 5.125 with no points. So conventional loan smoking is 50% down, 765 credit. So it's a good looking deal, but nice to be able to hook them up like that. And then, I was doing a rate lock video, I always go through the market, show, hey, here's what's going on. This is what happens when bonds go down. It's happening when bonds go up. We've seen bonds go down in the last week or so, but rates really haven't gotten that much worse. There seems to be a lot of support there. Wicks here on the bottom, these are good to see. There seems to be a nice support at this level. We'll see if it can hold. But if bonds do move higher, and I don't know if this is going to happen the next day or week or month or 6 months, I don't know. But at some point, we will get over this inflation hump. And if we're saying now that, hey, deflation is turning around, we should see deflationary things take place, prices should come down, the Fed is going to continue to tighten, this dollar here could continue to cascade higher. Or maybe this big run is all because people moving big money. I call them the big boys. The big boys have known what was going to happen the whole time, and they've been running this down because they knew it was going to take place. And maybe when the Fed raises later this month, they raise by 75 or 100 basis points, maybe a full percent will be happening. Maybe that will be the trigger to sell. Maybe that will be the final big deflationary punch that causes the dollar to start to weaken. I don't know, but the dollar has been getting strong. And that's something that a lot of people are unaware of. And of course, unaware of, but also unaware of, like, what does that mean? We do have the yield curve. And by the way, we're live. So if you want to drop a comment, if you want to say, ask a question, do whatever, go right ahead. Let's have some fun. All right. We're trying to learn here. We're trying to have some fun. We're trying to keep an eye on this market, trying to see how we can take advantage of it. Oh, wow. How about that? I'll give a shout out. Harrisburg, Pennsylvania is in the house. What's going on? Yeah, say what's up. Drop a comment. I will come back to those. Yield conversion between the 10 and the 2-year has reached its biggest point, or its greatest distance, let's call it, delta, greatest delta since 2000. Now, that doesn't mean a whole lot. 22 years, okay, I haven't seen it since then. Doesn't mean a ton. But this has been a recession indicator. This has been an indicator that things should get worse. And one of the things that's been interesting to me is how much they've been pounding this. It's almost like they want you to sell your stocks. It's what it feels like. Sorry, I'm just going to say it. It's what it feels like. And I want to do the exact opposite of what they want. So I am still short the NASDAQ, as I have been for months now. I have not covered yet. I don't believe that covering is the right thing to do just this moment. I want to see more activity here. I want to see what happens this month, at least, maybe further. I've got until September. So right now, a lot of people are talking about the monster 1% rate hike. Now, here's the most important thing about this rate hike that's going to take place later this month that we've learned. The market has told us how it will react to that. We know from a bond perspective, from a mortgage rate perspective, when the Fed raised 75 basis points, interest rates dropped about 0.25%. However, the marketing message, the message that went out on every news channel and every social media, I mean, it was everywhere, was rates went up, rates went up. That was actually the moment when things got the quietest from my perspective. As someone who represents buyers, helps people with home loans, I saw things right at that moment get really quiet. And it makes sense because if people have been looking and calculating payments or looking at anything or been pre-approved, and then they're like, man, the payments are already kind of high. And then they hear from 10 different directions, Fed raises rates further. They're going to go, well, just takes the wind out of their sails. But falsely, rates had dropped. Mortgage rates dropped. The overnight lending rate from the Fed to the banks, sure, it hurts the banks. Or, when they raise rates like this. Or in theory, it hurts the banks. Nothing hurts the banks. Nothing. Can't do anything. They make money hand over fist. Do you know that both Goldman and JP Morgan had entire quarters, entire quarters where their trading desks did not have a losing day. Entire quarters. So when I say the big boys, that's what I'm talking about. You can't trade not have a losing day. Not if you're a real trader. If you're a market maker, if you're manipulating the market, you can do it. It's the only way. Banks don't lose. Okay. There's nothing that's bad for them. Nothing. The whole system's built by them and for them. This monster 1% rate hike, that's our concern. The concern is that it's going to be plastered everywhere and people are going to go, oh, even worse time to buy than I thought. That's the concern. They won't know what's really going on. Interest rates, mortgage rates might actually drop 0.25%. That's what if you're a professional and you're watching this, you're a realtor, you're a lender, that's what we have to do is we have to communicate when that day comes. We have to push the truth hard. What actually happened today? If they raise rates 1%, that's a very deflationary action. Huge deflationary action. Should be very good for mortgage bonds and therefore mortgage rates. We will have to push that out the day that it happens. Try to get it as viral as possible. That, hey, mortgage rates dropped today. Why? How does that work? Mortgage bonds, like deflation, hate inflation. Raising rates by the Fed, overnight lending window of the banks, deflationary. That's a good thing. So we're gonna have to just prepare for that. Just be ready to have a post that you're gonna put out on that day. We all have to get on it together. The other thing they're doing right now, so there's you're seeing a lot of these top states, top cities. We went through the one yesterday on real estate that was tracking median values for some reason. These are America's 10 most expensive states to live in as inflation keeps rising. Very common type of headline, clickbait headline for MSM. What are these places? Well, you probably know some of them. But anyway, this is just interesting information to sort of check out. So I put this in there. And then they also did 10 cheapest states to live in. So it's very interesting to kind of see which one of these links people are going to gravitate to. But I just think it's interesting information to try to figure out, well, where might people be going? Where might people be coming from? What are things that are on people's radar? I hear a lot of people talking about leaving California all the time. I mean, you always do because it's expensive here. It is. But Southern California is the sweetest spot that I've ever been. I've been all over the place, and I can tell you that. So what is down payment on a home loan? How much is required? This is clearly an advertorial, as you see the 10 different ads pop up. Couple things I want to say on this before I talk more specifically about rates. We'll also jump to any comments if you guys want to say what's up. If you have a question, jump in. Happy to help and conversate. Down payment required on a home, how much? Okay, so conventional 5%, right? FHA 3.5, VA 0. Right now, there's down payment assistance programs through CalHFA where you can do an FHA if you fit in the box, and there's a 3.5% second that's forgivable. So you essentially get 100% financing with FHA through CalHFA. Pretty crazy. Pay your closing costs and you can buy a house. So, does that going to work for everyone? No, but that's something that's on the table. That's something that's possible, and it should be known, because at this point in time, I talked to gentleman today. He's flipping a bunch of properties. He's got 30 plus properties that he owns right now that he's trying to flip. It's like, I'm not getting like 0 showings. Because when you flip, as we were discussing yesterday on yesterday's video, if you're a flipper, this is a really rough market for you because you need to move that inventory quickly. Everything's based on hard money. Your daily holding costs are super high. If we had a bunch of flippers capitulate, that could cause like some opportunities in the San Diego market. But again, it's not macro enough to change the whole landscape. And most of these people are very well off because they've been crushing. I mean, just absolutely crushing it for the last couple of years. So it would have to be really significant there would have to be something that we can't see right now that would make that go sour. But that said, right now is the time. If someone like that who has pristine inventory, if someone who's a flipper who has absolutely completely remodeled homes, in fact, one of them he was telling me was a 1-bedroom condo, I think Talmadge area, like 350,000 or something like that. That's a smoking deal, y'all. If they're not getting any showings, that's where a down payment assistance buyer, that's where a VA buyer, that's where an FHA buyer can actually win, can come in and win, can come in and make an offer, can come in and get something done, So that's what the opportunity is at the moment, is to kind of figure out what that is. Now, I'll go back. All right, so this is the dollar cascading higher. You kind of see that? See those lines cascading there, that action? This most likely will continue until, at least, if the Fed's going to do a 1% hike, at least until then. That could be the top of it. But if that's the case and it starts to come in, that would be something that is more inflationary, right? From just a standpoint of how much your dollar can purchase. So we're going to keep an eye on this DXY, which I normally don't track, but because inflation, deflation is really what is the main concern, what's going on. By the way, got the call again today, going to be going on TV. I'll be on One America Friday at 1 p.m. With Stella Escobedo. She's an awesome host, and we'll be talking about all this stuff. She's going to ask me some questions. I'll find out what they are like the day before. But right here, what we're looking at is what really could be a very nice reversal pattern. This is technically, I don't have good graphing tools on this, but yeah, it's kind of my best. There's a reverse. There's a head and shoulders here, where this is the shoulder on this side right there, and this is the forming shoulder on this side. And it's just sort of an inverse head and shoulders that's sort of tilted to the right. We don't have great graphing tools here to be able to show you that on MBS Highway, which is an amazing site. Just has a very simple straight line ruler here. But you can kind of see that setting up. It's very possible that if we continue to see this kind of support that we saw like today was a day. Look, inflation came in hot today. That is not good for bonds, guys. That is really bad. Well, this should have been a really ugly day. And guess what? It was. When I woke up, I get my first alert from these guys, I think at 6 a.m. or something like that, PST. And when I got that alert today, we were down 50 something basis points down here. Supported broken. It was brutal. And that's kind of what you would expect with super hot inflation. But look what happened. Buyers stepped in, bought this thing up, and bought it back to support. Like, that's a very strong sign. This is a strong sign that interest rates are holding. They're holding, and the Fed is not in there buying right now. The Fed is not buying. So we can't sit here and go, oh, it must be the Fed pulling the trigger, just coming there, saving the day, just doing their Robin Hood thing. No. This is market. This is market organic now. I am going to make a video about the things that are danger to the market. Like, what are the things that could cause problems? The good news is they're all pretty far-fetched. But one of them would be the Fed could decide to crash the real estate market if they wanted to. All they have to do is just sell all their mortgage bonds. Rates would be 10% overnight. That'd do it. There's There's so many political implications that there's no way they're going to do that. But it's possible. It could happen, right? Even if it's 1 in a billion, it's possible. That's how far I'm reaching to find something that's legit as far as like a crash scenario is concerned. I'm really grasping that far. It's that far away. But, if things change, I'll let you know. So what I saw today was, remember we talked yesterday about how, listen, we were down a little bit yesterday. I expected today, if we were going to have a bad day, for it to get better. And it did, but it did also fully retrace. Here's the Dow Jones. Let's do this so we can just see the whole day itself. Do a 5-minute chart of the Dow Jones. You can see we gap down. I see it's trying to put this thing in there. Get out of here. There it is. So you can see we gap down. Yesterday's close, gap down to the opened here. So it gapped way down. Almost got a fill, pretty close to a gap fill. We'll call it a gap fill up here, the high point of the day. But look at the action. We made a bottom early. The Dow Jones likes to do that, right? This is a very common, very, very common action for the Dow Jones. As you know, I've said many times before, I used to trade Dow futures. It likes to, where it starts at the open, it made the first move, okay? And then usually the second move is the opposite of that. So it goes the other way and makes a new low. So it wants a lower low for the day, and then it wants a higher high for the day. So now it's made all those things. Now what do we get? Well, this right here is actually a higher low, and then again a higher low. So we made 3 higher lows. So in a day where we kind of like looked like it should be ugly, fear spreading and everywhere, big, horrible number, haven't seen in decades anything this bad, and somehow the action is not bullish. We're still down 200 points in the Dow today, but it wasn't terrible. It could have been a lot worse. Let's put it that way. So, and I'm not just trying to look at everything with rose-colored glasses. That's not my thing, but I'm just trying to be honest about this stuff. Like, what is really happening here? And I believe, so if you look at like crypto, we see we had a positive day across the board there. Well, that's interesting, right? That's really interesting. So far, all this inflation stuff, and particularly the strong dollar, which I mentioned earlier, has just decimated a lot of these cryptos, particularly the altcoins. But I mean, Bitcoin's down as well, like 70% from the top. So, it's, or 75%, I think now. It's down a lot too. Is there that much more to go? That's the question. A lot of people believe this is just the beginning. This is phase 1 of a multi-phase hellstorm that's going to rain down upon this entire economy. And I would just challenge, if you believe that, it's okay for you to believe. It's okay for us to disagree. It's okay for us to have a conversation about it. It's okay for you to post a comment. Like, go ahead, tell me why. Post a comment. Post a comment about what it is that's so bad. Post a comment with a video link to the video that you believe in from the YouTuber who has it all figured out. Please send that to me. I will watch all of them. I want to know if there's something I'm missing. I'm not just trying to be right, with where I'm at right now. I just want to know the truth. And from what I see, I don't see all these different legs. I see a whole lot of things all at once kind of went wrong, a whole bunch of things. And that has caused things to be a little bit off, right? You can say things are off right now. They don't feel normal. Things are a little bit off. But it does not feel like this massive, huge, sustained thing. It seems like a lot of little things have gone wrong, some things bigger than others, and that has gotten us to where we are. So we would need much worse things to happen, much, much worse. One of the crash scenarios that is probably, if there is going to be a real estate crash, probably the most likely scenario would actually be in like 3 years or something. Like if this was a false rally, so like let's say, this was like a test, and and then we just march higher from here, and real estate prices go up another 20% in 2023, let's say, or something like that. And then everyone who was bearish finally goes, all right, okay, you can't lose with real estate. Fine. Let's all just jump in the water. Then you could maybe get set up for a crash, but you can't crash with this many people bearish. It's just, you can't. It's not possible. You need those bears in there. You need them in the market. You can't have this many people on the sidelines. So many people on the sidelines. But I'll tell you, I'm really starting to get hit up. I'm really starting to get hit up by the investors, the one-off investors, the two-off investors are like, hey, I want to start poking my head around. Let's get pre-approved. I want to buy something. I want to pick something up. And these are people a lot of times who watch the channel. And that's, of course, the right way to handle it. You get yourself pre-approved. You hawk the market. You get yourself a good realtor. They'll help you hawk the market. Okay, meaning that you're looking over everything. As soon as it comes out, as soon as something hits the market, you want to see it right away. Is it something you're interested in or not? And be in a position to go and execute if you find a good deal, because there will be deals out there. We haven't had deals in this market for years. And now here we do. Now we finally have a chance where there's deals out there. People can go and just make an offer. There's probably a few desperate sellers out there amongst they're not all kicking tires. Take advantage. This is what you've wanted. This is what you prayed for as a buyer. But there's an underlying belief that everything's going to get worse. The rates are going to go up more and that prices are going to go down more. And that could happen. It's true. It could. But as I said, always be ready for the market to go both directions. We're just trying to figure out which way is it leaning. Are we leaning like this is it or close to it? Or is there a whole bunch more stuff to come? Can inflation continue to get much worse? I'm pretty confident that by the time the numbers come out next month, they will be lower than what they were this month. Just because there's certain metrics in there that we know have gone down. Now, those things could go up in the interim and it could all screw that up. But I don't think so. I think they're actually going to continue to go down. And if we really get a big number, a big drawback in those numbers next month, that could light a fire in the market. Could light a fire in the market where we have record wealth in this country just a few months ago, at all-time record wealth, record equity, people have record cash. A lot of people are pointing to, well, we also have record credit card debt. It's true. It's true. It happens every time. Every time financially savvy people get wealthy, the people who aren't get debt. It's the Joneses thing, because someone over here seeing what someone over there is doing, and they're not acting appropriately with their own budget. I wish they taught this stuff in school. I wish there was a better way, but you're responsible for your own stuff. So you got to act appropriately within your own budget. It's always good to tidy things up. Remember, the very beginning of the year, I was telling everybody the same thing in February. Tidy up. Tidy up. Go through your statements. Make sure you're not wasting money on stuff. Look at your car loans. Look at your insurances. Where can you shave a few dollars off here and there? It's good to do that every year anyway, but especially knowing that, hey, we might be coming into a period where things are a little unknown, where there might be a little bit extra fear. This could cause a few different things to take place, but most likely it's going to cause things to slow down. We're going to recess. We are in a recession. Yes, we are. Now they've been trying to manipulate these numbers, and maybe they'll cook up a number that's not negative for the second quarter. Maybe they will. But either way, we're in a recession. The yield inversion is really all you need to know. But the negative growth is there, and it's okay. It's okay. Recession does not mean crash. Recession just means that we're not going to be growing. We're not growing currently. We're pulling back. After massive growth for many years in a row, we're pulling back a little bit. That's not the end of the world. It's just not. And I want to, before we do that, let's do this. So I want to make sure you know that I'm available here and I'm here for you. That's what I do. So I'm a loan guy. Call, text, email me. If you want a loan quote, if you want to buy, you want to refi, I'm here to help. Want to make sure you get a good deal. Want to make sure you're not paying BS fees. Want to make sure you're not paying some super high rate. I just snagged a deal from a builder we got them a 0.25% lower rate and they saved $2,500. So, that's the kind of thing that we do all day here. So hit me up if you need me. But at the end of the day, you have to make the decision that's right for you. I would not recommend, there's a few things I would not recommend right now. If you're in business, I don't care what business you're in, I would not recommend starting a new marketing campaign right now. Don't do it. Okay. Response rates for consumer direct marketing right now are down significantly. Now, maybe you have some sort of unique product that is recession proof, I don't know, something. Maybe you do. Okay. And then that advice doesn't matter to you. But for most people, most businesses, especially small business owners, and a lot of small business owners who watch our channel, now's not the time to start a new marketing campaign. In fact, now's the time to actually dial back your marketing budget a little bit. Okay, go for the things that are the most efficient of the different marketing channels you have. Save some of that other money for now. Set it aside. And I know that contributes to the recession. I know that by pulling back the spending. But you have to be wise about this. It does not make sense to throw good money after bad. It does not make sense to run marketing campaigns when response rates are a fraction of what they normally would be. It's just not a good time. I would say take the money, set it to the side, maybe relaunch the campaign in 3 months, maybe 6 months. Keep an eye on things. I'll keep you posted on this end. That's one thing I would highly recommend. I would also highly recommend getting very intentional about what you're trying to do with your finances. This is always good practice. Be very intentional. This is what I plan to do. And if you can, BRRRR. If you can BRRRR right now, do it. Do it. You will find that there is so many opportunities for deals. So when you say BRRRR, buy, renovate, refinance, rent it, repeat, right? And this is something I have people in contract right now who are doing this. I'm talking to a lot of people who are looking to do this. If you're in a position where you can buy property and renovate it to then therefore refinance in 6 months to a year while you live there and then rent it out, you'll be glad you did that. I'm very confident you'll be glad you did that. And, we're probably going to see rates take a dip at some point in the next year or two. Could be a lot sooner, though. It really could. I mean, if you think about it, it could be as soon as next month. It could. What if the inflation number comes in next month, came in 9.1% today? What if this number next month, what if the headline is inflation declines to lowest levels since whatever, 6% or something? Then what? Well, does that mean we're over the hump? Not necessarily, not automatically. But inflation really started to rear its ugly head towards the end of last year. So the year-over-year numbers will have a better shot towards the end of the year. So that's why I think it's probably 6 months to a year away at the soonest, but it could be sooner. And the Fed's tightening 1% maybe, or 0.75% this month. That's a very deflationary action. They finally started doing something. People became aware of this. It takes a while for these numbers to flush through the system. I think it's far better than what most people believe. And I'm waiting for the other shoe to drop. I'm waiting for that piece of news where I go, ooh, that's the one we didn't see. Oh, gosh, that's right. Those guys over there doing that thing. Yeah, they're going to kill the market. They're the ones we've been waiting for. I just haven't seen any of that yet. So I hope I do. Let's see here. I like this. We'll do questions and comments now here. First of all, I love the name. And aspire to be a floor trader for Goldman Sachs. Well, if you do become a floor trader for Goldman Sachs, you have to email me. Okay, you'll be my inside guy. It'll just be you and me who know it. You can even email me through an alias. Okay, if you get there, you let me know. Same user comment. What's the 30-year fixed rate on a mortgage today? So for conventional today, I locked a 5.125 earlier. That was 50% down, 765 credit on like $800,000 purchase price. I also quoted for an investment property cash out was 6.25. That was this morning. So investment property cash out 6.375 was the cash out. The rate and term refinance for the investment property was 6.125. VA, we locked one today under 4.5%. It's conforming balance. I think it was 4.472. If you use UWM, they kind of give you these funky par rates. But that one was so right around, let's say, mid fours for FHA and VA, low fives to mid fives, maybe high fives for depending on credit score for conventional. Investment properties still kind of in the low sixes. Second homes, same deal. And overall rates, if rates stay here, and this is kind of what I know I've been saying this for months, but if rates can just normalize here for a while, we'll be in much better shape. If we can just hang out in a certain place that can be normalized so people get used to it. I started seeing that for the first time this week. Buddy of mine bought a place in Florida, and he was, texting me like, "Hey, I got a 4.875." Stoked. Paid a point for it. It's like, I got a 4.875, my lender in Florida. And I'm like, okay, that's a good sign, because to him now 4.875 is a good rate. Imagine a year ago when people were getting conventional loans for 2.75, 2.99. We did a lot of 2.99s. You'd say, hey, how about 4.875? People are like, what are you talking about? The hell out of here. And so now it's being normalized, and that's important. It's important to normalize the rates, because there's sticker shock issues, and that's been a part of the problem with this market. Is we've had a lot of sticker shock issues. So people who were pre-approved and who were writing offers for months and months and months, and then all of a sudden they finally get one accepted, or they get 2 or 3 accepted on the same day. And they're like, whoa, what the hell's going on with the market? And then it's like, oh, you quoted me 3% at my pre-approval. Now it's 4.5%, and many variations of that. And so that caused things to be weird for a little while. Caused a lot of cancellations on deals that got into contract. Caused a lot of people to run around and do things, waste their time. Buyers agents wasting time running people around. Listing agents wasting time getting people in contract and getting back on the market. And so that was really where, we first kind of felt the umph of this. And of course, it could get worse, but it always could. What's up, Alex? VA rate, mid 4s, mid to high 4s, depending on credit score. It's a good place to look at it. I have seen in locked low 4s, but kind of a rarer circumstance. Good question. Yeah, variable. So like ARMs do make sense in some circumstances, like jumbos, for example, especially if you have a bigger down payment. We've got some banks that have really low rates for jumbo loans where you can get into the low 4s. So it's kind of crazy. Like the lowest, if I look at my pipeline of locks here, okay, I have a kind of a lower credit score VA purchase at 4.875 with lender credits. I have investment property purchase 6.5. There's a VA purchase 4.79, VA purchase 4.71, non-QM 6.625. There's another VA purchase at 5%, conventional purchase 6.2. So like, they're kind of all over the place. VA purchase 4.4, conventional purchase 5.125. The lowest rate I have on here, the point of this, I guess I keep going, but the point of this, the lowest rate I have on here is a jumbo loan, which is nuts. And it is an ARM. It's fixed for 7 years, but that's the lowest rate I have on the whole sheet. So, great question. All right, cool. All right, guys. Hey, thanks for your time today. Thanks for hanging out. Send me those videos. If you get a video of the market crashing and you're buying into it and you're like, no, this guy really knows what he's talking about, send it to me. I'm going to start roasting those videos. And if you need help with a home loan, give me a shout. Shoot me a call, a text, an email. I'm not too busy for you. Some people think that, oh, I didn't think you would respond. You responded so fast. That's what I do. So I do for a living. I like making the videos. I like educating. I like learning myself. And I'm happy to help share the love. And if you know someone who wants to buy a home, refi, have them give me a shout. You guys have a great night. And I will see you soon.